Doc's Market Minute for Monday, August 24th. I'll tell you what, I take a week off during what's normally one of the lamest periods of the year. The dog days of August, the last couple of weeks of August, usually are very low volume, very low conviction of anything at all. Really what we've seen over the last couple of days is all hell is starting to break loose. Now, I'll tell you what, this is not a surprise in the least. All right, this is not a surprise in the least, and I've somewhat felt like the little boy that cried wolf over these last few months because I've been warning about a big move coming. Big move coming, and we're starting to see that big move starting to unfurl. And so what I thought I'd do this morning is there's 5 things that I've been talking about over the last few weeks. If you want to, go back and watch all the videos again because you'll see these points illustrated in here. But this is such a great time to learn from these types of moves so that you're not surprised the next time that one of these comes along. And it may be not that long from now we see another one of these. Okay, so point number 1 is that we had a broadening pattern on the S&P 500. Okay, broadening pattern. We had, in effect, a narrowing pattern as we narrowed into, I think it was around the end of May, is when the market initially topped out here and the volatility got very tiny. And since that point, what we've seen is the volatility, and when I'm talking about volatility, I'm talking about price volatility, so realized volatility has been expanding. So even forget about this week, last week, what we've been talking about is the volatility has been getting bigger and bigger like that. So this is what's called a broadening pattern. And what it's showing is that the market is becoming more and more unstable. When we have a bull market, a quiet and trending bull market, everything is very stable. It's sort of like Groundhog Day, as it seems like every Monday we go higher, and a lot of times we'll have a dip in the morning, but then the dip recovers by the end of the day. And sometimes it gets a little boring and frustrating in that it's the same thing over and over again, especially spread sellers hate that type of market, but it is what it is. But we can see that really since this point, here was like a miniature broadening pattern that we had in October of 2014, and that led to higher prices. And then it got quiet again into May, but since that point, we've seen the volatility, the realized volatility start to expand, and that's always a warning signal that something's about to happen. Number 2, I'm going to go over to the Dow for this, but the Dow had what's called a death cross. This is the 50 and the 200-day simple moving averages have crossed to the downside. The 50 is crossed underneath the 200. Now, you can go back over time and test these things out, and sometimes they're not significant at all. We've seen plenty of times where the Dow has given us false signals in terms of these death crosses. We can go back and see a few of these here. Really, we almost had one back at the beginning of 2013, but that ended up being false. Okay, and we definitely had one back here in 2011, the end of 2011, beginning of 2012. But as you can see, this one ended up being a false cross, and it led to a huge rally from there. And so if you go back in time, really the last one before that was, let's see, back here, let's see if we did one. Yeah, we had one in 2010. So we had this whole flash crash, and we had a correction during the summer of 2010, and that led to a false signal as well too. All right, but the important thing is here is the one from 2007, early 2008, and that was real. So it's kind of frustrating. It's not that valid of a signal, but it is a signal. It is one piece of evidence that should go on the pile. You can't make an entire decision off this. But when I see one of the major indices showing a death cross, I sit up and pay attention because it may be trying to tell us something. In this case, the Dow is the very first one that's done a death cross, and we may see other indices crossing as well too this week. Okay, back to the S&P for number 3. The number 3 point here that I've been talking about ad nauseum, literally for weeks and weeks and weeks, has been the fact that we have an enormous amount of energy that's been built up here over the past year or so. Okay, so not only on the monthly chart's going nowhere at all and has restored itself now to a full load of energy. So that's like having a full tank of gas. And the theory behind this is that markets that are trending like this, that are going in a linear fashion, take a lot of energy and actually get us, it shows a very linear market, and markets cannot sustain themselves if they're operating in a linear fashion for too long. What they have to do is they have to start shopping around. They have to start going in a much more non-linear fashion, and that's what we've seen. You can see this on the weekly chart, is all of this price action really since around the February timeframe has been extraordinarily non-linear. And this has the effect of like coiling up a spring like this, just tighter and tighter and tighter, right? You keep winding that spring and something's going to happen. It's going to come flying out of your hand in some direction. Now, we don't know which way it's going to go flying out of here. It certainly could have just as easily popped out to the upside. But this leads me to my number 4 point here, is that the market had every chance to break out to the upside. With this amount of energy that it had, it should have put on another 200-point move. And this is what a lot of analysts were looking for by the end of 2015, was a move somewhere up in the 2200s on the S&P. So everybody was kind of expecting the same thing. Everybody was expecting that the former trend would take over and that we would pop out through the highs and head up to somewhere in the 2200s. Okay, but multiple rejections at the high. And what I said a few weeks ago is, look, if it keeps bonking its head against the highs up here without result, if it just can't get through, then what's going to happen is akin to a pressure release valve on a boiler. If the steam builds up the pressure so high that it has to go somewhere, if it can't go into the normal route of things, whether it's a piston or some other form of motion, then what's going to happen is the relief valve is going to pop and that pressure is going to come out to the downside. And this is what we're seeing as of the last 2 days. Only the last 2 days alone, and we've seen about a 100-point move in just a couple of days, which is really significant. So this is one where everybody is sitting up and paying attention to this. So again, range contraction like this leads to range expansion. This is what the market does. It goes forever in these states of moving and then consolidating, moving and then consolidating. But it can move in either direction, and this is why we need to understand price action. And the price action that we were watching was this triangle pattern. We knew that any break of that triangle pattern, either to the upside or the downside, was going to be significant. And it made no doubt about it last Thursday that the break was to the downside. Okay, point number 5 that I want to bring up is from stockcharts.com. It's got this really neat ticker, which is SPX A200R. This is the percentage of S&P 500 stocks above the 200-day moving average. And what we use the 200-day moving average for is generally to say whether something's in an uptrend or a downtrend. So as of last week, we only had about 55% of the stocks in the S&P 500 above the 200-day moving average. So you can say that about 45% of them were already in some type of a stealth bear market. So what we're saying here is that the majority of the market had already started to turn south, and the only thing that was propping everything up was about, maybe just a couple of sectors and a dozen very, very strong stocks that were high cap, right? So they were kind of keeping everything held up. And the point that I was making at that time was, look, either the rest of the market gets it in gear and supports these dozen stocks, or these dozen stocks also start to fall, and then this whole thing is going to fall down. So it could have gone one way or the other, but this is always a good leading indicator to see what's going on with the health of the market. When we have the rest of the market going into a stealth bear, we have to sit up and take notice to that. And this is what we saw also in 2011, is we saw this stealth bear happening underneath the hood while the rest of the market went sideways. And we know at that time it's very vulnerable to these types of moves. And so we're seeing almost a carbon copy of the move that we saw back in 2011 so far this week. So those are my 5 items that I've been talking about now at length for a long time, over and over again. It's seemingly into the wind, right? As this market didn't seem to move at all. So now what I want to do tomorrow is I'm going to talk about what's next. There's three possibilities for what's going to happen next, and we need to map those out and understand what those are so that we're not surprised by anything that goes forward from this point on. No more deer in the headlights stuff, right? We want to be prepared. We want to have a plan of action based on what the price tells us it's going to do. It's not fortune telling. It's not predicting the future. It's more outlining and laying out a plan and then following that plan based on what the price does. Thanks for listening today. Hope to see you tomorrow.